Okay, let's dive right into this masterclass on the hidden mechanics of profitability. Welcome to The Explainer. If you're the kind of person who absolutely loves breaking down complex business challenges into structured, actionable strategies, well, you are in exactly the right place. Today, we're basically cracking open the ultimate consultant's playbook. We're going to trace the entire life cycle of a business, looking at the exact frameworks top-tier consultants use to unlock massive value. We'll cover everything from that very first capital investment all the way through to scaling your human capital.
So here's our game plan for today. First, we'll look at capital costs and TCO. Then we'll talk about maximizing the golden hours. Third is the menu engineering matrix. And finally, number 4, fixing the talent funnel.
All right, let's kick things off with Section 1, Capital Costs and TCO. Take a look at the wildly different price tags for seemingly identical business assets. Let's say you're launching a food truck. In the US used market, you can get started for, $30,000 to $100,000. It's definitely budget friendly, but let's be real. You're essentially buying someone else's problems and you're definitely going to need a hefty repair budget. Now, a brand new custom US truck gives you that nice warranty, but it sets you back a staggering $75,000 to $200,000. Then there's a third option, a custom built from China right in that $20,000 to $60,000 range. It's a really smart value play, but you're trading money for time as you navigate all those tricky import logistics.
And this brings us to a really crucial consulting question. How do we actually evaluate these investments over the long term? See, amateurs just look at the sticker price, but professionals, they look at the total cost of ownership, or TCO. You simply can't just ask what it costs to buy. You really have to ask what it costs to run.
To put that into perspective, let's look at this McKinsey case study that compares a traditional diesel truck to a highly efficient electric truck. A standard diesel truck eats up about $55,000 a year in fuel and heavy maintenance. But the electric truck, it operates at just $31,000 a year. Electricity is just fundamentally cheaper. And because an electric motor has significantly fewer moving parts, it actually cuts your maintenance by about 50%.
So over a standard 4-year useful life for these assets, that operational efficiency yields a massive $96,000 in total cost of ownership savings. I mean, that is not pocket change. This is exactly the kind of math a consultant uses to justify a seemingly outrageous price tag. Because of that $96,000 in generated value, a manufacturer can confidently charge a value-based premium price, let's say $221,000 upfront for the electric truck, knowing full well the client will still break even or come out way ahead over the asset's lifespan. Okay, moving right along to Section 2, maximizing the golden hours.
Now, in the world of operations, the 80-20 rule is an absolute reality. The data shows us that 80% of our restaurants' sales occur in just 20% of their operating hours. Think about a Friday night from 7 to 10 p.m. Those are your golden hours. The crazy thing is, most operators spend entirely too much energy agonizing over their slow Tuesday afternoons. But the real money? It's literally in raising the ceiling of your absolute busiest times. Maximizing these golden hours requires some serious, meticulous preparation. First up, you have to set up your stations for pure speed. This means every single piece of glassware is polished and stocked way before the rush hits, and garnishes are within a 6-foot radius of the bartender. Second is strategic staffing. You don't just throw bodies at the problem, you put your fastest, most accurate staff on the highest turn sections. And third, utilize dynamic pricing and strategic scarcity. Bundle your high-margin items to reduce customer decision fatigue, and don't be afraid to temporarily trim those slow, complex items off the menu entirely during the rush. And if you manage to pull this off, the math is explosive because your fixed costs, your rent, your utilities, your core labor, they're already paid for the day. So any incremental revenue you squeeze out of a peak hour is highly leveraged. Increasing your peak sales by just 20% doesn't just bump your bottom line by 20%, it can actually lead to a 60% profit margin jump on those specific incremental sales. It's practically pure profit.
All right, let's transition to Section 3, the menu engineering matrix.
Before we even look at the matrix, we really need to clarify a massive myth in the industry, and that's the food cost percentage. Operators absolutely love to focus on keeping food costs at 28 or 30%. But listen, a low percentage doesn't automatically mean high profitability. We need to look at the contribution margin instead. This is the actual hard dollar amount each sale contributes toward profit. It's literally just the selling price minus the portion cost. Think about something like sauerkraut. Cabbage is cheap on paper, maybe 20 cents a pound, right? But after you account for yield loss, the prep labor, and the fermentation time, the actual contribution margin of that dish might be surprisingly low.
You can't deposit percentages in the bank. You can only deposit dollars. To actually execute on this, you cross-reference that hard dollar profitability with customer popularity, which classifies every single product you sell into one of 4 quadrants. So you have your stars, which are high in both popularity and profitability. Then you've got plow horses. These are popular but low profit. Next are puzzles, which are highly profitable but rarely ordered. And finally, the dogs. Those are low in both popularity and profit. Okay, let's simulate a consulting interview for a second. Look at your own menu. Imagine you have a highly popular item that guests order constantly, but the margin is just terrible. It's a classic plow horse. What is your strategic move to fix it? Well, your very first instinct might be to just hike up the price, right? But guests remember the price of popular items. A $2 jump on a crowd favorite burger is going to be noticed instantly and can seriously damage customer loyalty. The true consultant's move here is to make invisible operational tweaks. You tighten up portion control. You improve the yield of the ingredients. Maybe you swap out a side dish. These small operational changes compound dramatically on high-volume items. And the best part is the customer never even notices a difference. So what about the others? Well, for puzzles, the economics already work in your favor. You just have a demand problem. You fix this with descriptive language. Simply changing a menu item from flatbread to wood-fired flatbread with charred lemon changes the perceived value instantly. And for the dogs, you cut them decisively. Honestly, no mercy. Every single low-performing item on a menu creates hidden operational complexity, unnecessary prep time, and waste. If it's not strategic, just get rid of it. That brings us to our final section, number 4, fixing the talent funnel. For this, we're going to look at another fascinating McKinsey case study. Picture a major retail client with 1,000 employees. They want to better mirror their customer base by adding 4 more women to their 20-person executive suite. Now, that sounds like a fairly simple hiring directive on the surface, right? But as we're about to see, scaling leadership actually requires some pretty deep systemic engineering. To solve this, you have to map out the entire career funnel. At this specific company, out of 1,000 total full-time employees, 500 are entry-level. But then that shrinks to 400 managers and then drops drastically to just 80 directors, and finally, just 20 VP or executive spots. The funnel narrows aggressively. To get those 4 female executives at the very end of a 10-year pipeline, you really have to figure out exactly where the drop-off rates and internal promotion bottlenecks are occurring for female talent. You absolutely cannot just guess here. You have to deploy targeted, data-driven interventions. You analyze the stage-by-stage dropout rates to see, for example, if women are leaving at that crucial manager-to-director transition. You model whether it's mathematically faster to balance external hiring at the director level versus just waiting for internal promotions to mature. And you audit compensation and the overall employer brand perception to ensure you are actually an attractive destination for top-tier talent. It's really about treating HR with the exact same rigorous mathematical funnel analysis as you would a sales pipeline. From calculating long-term ownership costs and leveraging those golden hours, to engineering product matrices and fixing talent pipelines, we've really covered the complete life cycle today. You see, the consultant's playbook isn't magic. It's just structured clarity applied to a messy reality. So I want to leave you with this provocative thought. Which of these 4 frameworks will you take and apply to your own career or business tomorrow? The tools are all right here.